A quick intro on our side. My name is Darius. I'm an expert part of the McKinsey Center for Future Mobility. I am working in that segment since now more than 7 years. Have been working with clients across the entire micro and mobility ecosystem. I'm also leading our micromobility solution. So I'm particularly responsible for our market sizing and also our consumer insights. And as you can guess, we have brought a couple of our latest insights today with you. Kathrin, maybe also a couple of words from your side.
Yes, thank you, Darius. So I'm Kathrin. I'm based in Stuttgart, also an expert with McKinsey in our McKinsey Center for Future Mobility. I'm also dedicating a very large share of my time to micromobility, mini-mobility, and two-wheelers, and together with Darius, developing all of our market perspectives and trends. I'm also owning our consumer pieces, where we do have a lot of proprietary consumer research, and with this, serving clients across the industry. And we are always, of course, following the industry closely. So it's already, I think, also my 4th time here at the conference.
Right. A couple of words also on the Center for Future Mobility for those who do not know it, which is basically our McKinsey internal think tank on the future of mobility. So we serve more than 300 clients per year on all topics around mobility, right? Starting from autonomous cars up to EVs, up to shared and micro mobility. Us too, we are part of a very specific group. Of course, we have to say that within the MCFM. We are part of around 40 to 50 colleagues who do nothing else day in, day out than trying to understand market sizes and doing market projections. And like this, of course, we have served a lot of companies, investors, private companies, but also regulators across the space. And that leads us a bit to also the agenda that we have brought for you today. First of all, we want to deep dive a bit more into the status quo of the shared micro market today. Secondly, we then have, of course, brought our latest insights on the e-bike market. Kathrin will lead through that. As a third point, we would like to go into the shared micromobility value chain. That's something that we typically don't do, but we've seen a couple of interesting innovations in that space recently. And then, of course, want to, as a 4th step, tell you a bit how we can support you guys in shaping your strategy going forward. Let us start with a quick description of where the market stands today. And typically, when we describe the shared micromobility market, we do that based on 3 phases. We started in 2017, 2018 with a phase where basically a lot of new players popped out on the market. The whole theme was about how can I increase my top line, how can I land grab market shares as soon as possible. Also, of course, facilitated by the fact that the cost of capital was quite low, and therefore we have seen a variety of players around the market. At the same time, we have also to say profitability was not on top of the agenda, both not from investors, but also not from the shared micromobility market. Following COVID, we have then seen 2021, 2022, a very, so to say, intense market consolidation that was to be expected, where, of course, only the most profitable and also well-established players basically survived that phase. We have, of course, also seen cost of capital increasing, which is a reason why also investment volumes decreased quite a lot. But at the same time, what is quite interesting is that regulators, especially cities, have acknowledged the advantages of shared micromobility, being a good alternative to the quite costly private car in a very sustainable and also cost-efficient way. And have therefore, even in the US, stepped up the game, right? We have seen cities which have actually nothing to do with micromobility before, investing into bicycle lanes, building up charging and parking racks. That was quite an interesting phase. And right now, where we believe we are in, probably since end of 2023, 2024, is a phase where the industry is probably growing much more sustainably and also much more mature, with a deep focus on profitability as compared to before, right? We have seen the first players reaching profitability even for a couple of consecutive years. Lime is one of them, right? Where players really try now to double down on, for instance, how can I increase the lifetime of my vehicles? How can I also make my operations more efficient? Or how can I reduce the costs across my supply chains? At the same time, investments, interestingly, have not ramped up for different reasons. But what is definitely certain is that investors are now looking at very specific players who have actually proven to have a good and financially sustainable business model, and have also proven profitability, or at least to be close to it. At the same time, you can see it here, we have also seen on the regulatory side a slowly maturing regulation. What that means is we have seen cities that have been trialing or pilot testing shared micro for many years, now including or incorporating it basically as a permanent scheme. That is something which is especially happening in the US. And in Europe, at the same time, we have seen cities which used to have very, very strict requirements on fleet caps, for instance, to slowly expand the service areas, to slowly increase the fleet caps, also is, I think, a very good example, which is, of course, also showing a certain maturity in how they regulate the market. Now, the interesting thing is, if we now look at the key characteristics of the market, you can basically tell the same story looking at the market numbers, right? If you look, for instance, at the average number of players per city, we have seen here a constant decline. That's now for the shared e-scooter market, from roughly 6 to 9 players per city at the very beginning of the market to now only 2 to 3 players today. And we also expect that this is probably going to even intensify, and we expect probably only 1 to 2 big shared micro players per city in the next 2 to 3 years. EBITDA margin, as you can guess, has also improved quite a lot, from very low negative values below minus 30% to probably on a market average now breaking even or being even slightly positive. We have seen that roughly 50% of all the European shared e-scooter players are profitable today, at least when you look at the e-scooter market. And funding, as I said before, has indeed decreased over time, but it's now much more, so to say, stable and targeting really the players that are most profitable, right? But probably what the most interesting number, probably for me at least, is that despite all of these market phases, the actual number that consumers do using shared micro has almost fivefold, right? And this is the same also, by the way, in the US. And this really shows that consumers are indeed willing to use shared micro. It's, as often in life, right, more about the conditions and the circumstances, but I think that's really a good market indicator. Now, if you look at it from if you will, into phase 3 from an operator's perspective. As I said, the profitability now, or achieving profitability, is something which is now the clear focus of players. Lime, Voi, and also Donkey Republic have been very good examples of how to achieve profitability across the segments. For those players where probably profitability is not reached yet, we do see also that players are starting to adjust the business model. Lyft is doubling down on B2B bike sharing in the US. Ride Panda, which used to be a marketplace for D2C bikes and scooters, is now shifting to become a B2B player only. And yes, we have also seen M&A activity still happening, but definitely at a much lower level than before. Kultra buying Cityscoot, or also the very famous Dot merger happening in 2024. From a regulator's perspective, I said before, we do see regulation slowly maturing. We also see that roughly 60% of cities in Europe and the US are supporting shared and also private micromobility in a certain way, right, by either building bicycle lanes or by providing grants. And this is something that we expect even to increase, right? We have seen, of course, a bit of a diffusing landscape in terms of regulation. First cities are now trying to, again, as I said, like Oslo, trying to ease a bit the shared micromobility market by doubling down or doubling the allowed number of shared e-scooters, or by tripling also the service areas. But on the other hand side, especially on a national level, you can see the example here of Italy, we still are in a phase where probably the technical requirements when it comes to e-scooters, but also e-bikes, is not set yet, right? That's why we have many countries trying now to impose stricter regulation, which of course in the short term leads to a certain dip in the market, but overall in the long term probably it's something which is harmonizing the market and therefore also improving the outlook. But what we have seen basically the whole time, and that's especially true for private micromobility, is that both cities and also countries are still continuing with their monetary incentives. Just recently, the UK announced to abandon the tariffs for non-folding bicycles from China. We have seen grants or investments into Oni and Swabi, who are aiming to increase or to build up charging and parking infrastructure in the US. And also New York City, right? They launched an e-bike trade-in program to really help the delivery workers to get rid of old e-bikes and to replace them by new ones. So all of these, to maybe round it up, all of these signposts make us still very optimistic for shared micro and also for private micromobility. And this is why also our market forecasts continue to be quite optimistic. Now, Kathrin will continue with especially the e-bike market. We've brought you that perspective with us today and shows you the market focus for now private and shared micromobility.
Yes, thank you, Darius. So as just mentioned, we want in this section to give you an overview of the recent e-bicycle industry, but also an update of our perspective towards the next 10 years. And as you all know, the bicycle industry has seen some challenges now in the last 2 years, coming from a demand peak during the pandemics with a subsequent drop in demand and a combined overproduction leading to high inventory levels and also to a drop in prices. But what we still saw is that within that period of challenge, so to say, that the e-bicycle industry is and was more resilient in many countries versus the traditional bicycle industry. We currently see more of a stabilization phase, and we also expect this market to recover now in the upcoming years even more and to still be and become the main driver of the overall bicycle industry in the next years. What does that mean if we look into numbers? So this is now the view for Europe, and we compile here 5 relevant markets, being Germany, Netherlands, France, UK, and Spain. And those 5 are for last year valued at $10 billion and a sales volume of roughly 3.4 million unit sales at a price point of $2.7K US dollars and electrification rate of 27%. So already almost 1/3 of the market. If we look into how this will develop in the future and how our expectations are, so to say, we expect this market to almost or to more than double to $22 billion in 2033 and reaching more than 5 million units sales for the e-bicycle sales volume, which would lead us then to an electrification share of 35% and a price point which is typically higher in Europe in the future versus today. That's our assumption of 3.7K. And this price increase is based on what we also saw in the past, that prices were increasing in Europe. We see a shift of consumers to more premium products. We see, for example, willingness to pay for connectivity features, maintenance features, and so on, which then drive this price increase in the future. So, and if we think about what are the drivers for this growth, I think regulation is one key driver that we really see. Darius was also just talking about this, and this has many shades. So we do see a lot of purchase subsidies in Europe, even for very high sums, for example, for electric cargo bicycles. I think we have a few hundred schemes that are active or have been active. We see what Darius just mentioned, cities that are involved that want to move people away from the cars and, for example, implement measures in the inner cities. We also do see that cities and also on a national level, there are modal shift targets that are sometimes quite ambitious. So we also expect that there needs to be some measures to really get there. And maybe more a trend of the industry, what we also currently see, and this especially is quite popular in Germany, but at the moment also spills over to other markets, is corporate bicycle leasing, which makes e-bicycles in general more accessible, but also makes higher priced products more affordable. So in the German market at the moment, every other e-bike already today is sold via a leasing scheme. And this is also something that is driving adoption further. And then, of course, besides that, we also see an inherent consumer pull, for example, for ecological reasons, but also technological developments. We have larger batteries, we have better form factors, maybe better weather protection, etc., which then unlocks new use cases and longer distances, etc., which is further fueling the growth. If we quickly look at how this breaks down into the 5 countries that I just mentioned, maybe 5 facts to take from this slide. So as you can see, the German market is by far the largest one. It's a $6 billion market estimated last year with 2 million unit sales. We expect this market to reach in 2033 roughly 3 million unit sales, which would mean an electrification rate of more than 70%. Today we are already at more than 50% for the German market. Secondly, if we look at Netherlands and France in terms of the market value, those are the 2 markets that are ranking at the 2nd place, both at $1.3 billion. If we look at the unit sales, however, we see that France is still having or already having higher unit sales, so roughly 200,000 sales more. This delta then comes basically from the price point. So we do see that French consumers on average pay $700 less for an e-bicycle versus the Dutch consumer. And in the future, we expect this price difference to remain and both markets to reach roughly $3 to $3.5 billion in 2033. And then very quickly, UK and Spain, still minor markets, but we expect them to catch up, especially because they are already in discussions also to bring up similar regulations to what we see in Germany, France, etc. And then very quickly on the North American market, this is in comparison to Europe, still very small. So we have a $2 billion market, roughly 1 million unit sales. Electrification is still quite low, so we are below 10% in the US market. However, we expect the market to see significant growth in the next 10 years, expecting a $5 billion market and almost 3 million unit sales. I think key drivers here for us are definitely that we already saw a huge historical growth in the US market in particular, so 10x in 10 years. And also the very strong purchase subsidy environment, which is quite popular in the US. Of course, there is some uncertainty when it comes to the current administration, so this is a kind of scenario that we would expect, assuming that this will stick in place. Having that said, Darius, for the last part.
Thank you, Kathrin. I'm trying now to rush a bit. We're coming here to the end of our time. But what we still wanted to bring you along is also how we at the moment see the shared micromobility value chain looking like. So what we basically did is we looked at 4 segments, starting from vehicle manufacturing over asset provision, which includes the financing and the insurance of the vehicle, going over fleet operations and mobility services. And what we try to understand is how is the cost breakdown for each of those value chain segments? And not surprisingly, fleet operations, of course, accounts for the largest part of the costs still. This is now an example for a shared e-scooter operator in Europe. Roughly 40% of costs are distributed to fleet operations. This number, by the way, used to be much higher, like 4 or 5 years ago, used to be like 60%. But what struck us most is actually that the upstream part, so the vehicle manufacturing, including the components, the integration of the vehicle, the testing of the vehicle, is still accounting for roughly a third of the costs, right? And why is that interesting? Because it's usually not the core competency of a shared micromobility player. So yes, they have expertise in improving the relocation, in improving the operations, but the core expertise is definitely not in vehicle manufacturing, right? And we bring this along because we have seen a very interesting and innovative idea on how to tackle these high costs, which we, at least on our side, call digital manufacturing platforms. Basically an idea of or the possibility to bundle different players across the upstream ecosystem, starting from prototyping over manufacturing, going over warehousing, delivery, and after sales on one platform. Why is that interesting? Because back in the days, still today, right, many shared micro operators are still trying to basically reaching out to all of these players bilaterally. That, of course, leads to high lead times, to high costs. And now the interesting fact is that you, as a shared micro operator, but also as a hardware brand, for instance, are now able to reach out to one of these platforms who give you direct access to all of the participants across that ecosystem, right? What have we seen recently is that especially fulfillment costs, they could be reduced by roughly 50% for some cases in the US. And we do think that this could be an innovative way of how to, so to say, externalize your manufacturing process and at the same time also gain access to the most profitable and interesting, so to say, companies across this ecosystem. Happy to dive in deeper into that if you want. We will also publish a McKinsey article on that where we go much deeper into that sector end of this week. Maybe as a last point, if you have any questions about our work, right, we have worked now with more than 70 companies in the micro segment, private and shared companies, over the last 6 years. What we do is very operative work, not only the typical McKinsey strategy work. So we also help companies to accelerate their sales. We, of course, work also with investors, trying to also shape investor documents. And yeah, that's basically us. Thank you very much for the attention. If you have any questions, let us know maybe afterwards. Thank you.
Thank you.